Hello everyone, this is PC here from Global Alpha Search. Welcome to 2022. I hope you had a great holiday season. We're starting the new year right now, so it's time for me to summarize our portfolio for the month of December 2021, the whole year 2021, and show you my expectations and projections for this year going forward. Let me just start with sharing my screen with you, and we will proceed with the presentation. All right, so portfolio update December 2021. Let's kick off. Uh, Just a second. The portfolio overview is where we usually start. The synthetic internal benchmark that we have established recently for our portfolio was up 3.9% for the month. Our portfolio was up slightly less than 1%, so we underperformed this month, unlike the last 2 months. The equity allocation right now is 56.4% as far as pure equities are concerned, but we also are exposed to equity ETFs, and adding it all up, we're at an aggregate equity value, weight of approximately 80% right now in our portfolio. The average risk for December was 4%, so in line with our target. Maximum risk was 5%. The biggest holdings as of now look as follow. SPXL, this is the leveraged long-term long equity, trade for the S&P 500, currently weighing approximately 13% in our portfolio. I'm planning to be slightly cutting it to manage the risk in January, but I still believe there is upside in the first quarter of 2022 for the US equities, so I generally plan to stay exposed long a directional place like the SPXL in my portfolio. We've also added up exposure in Facebook. It's pretty much my highest conviction blue chip long right now. Slightly less than 10% of the portfolio was allocated to Facebook. I think the metaverse story will continue in 2022 in general, and Facebook is obviously perceived as the leader of this trend. It's also quite fairly valued. It had a little bit of a correction lately, and we bought into the dip. We're already up on this holding. Then Tilt, so long-term U.S. Treasuries, we underweight this holding versus the benchmark for the current cycle phase of 15% because of the fact that mainly the long-term yields are trading generally said sideways as far as the 10-year yield is concerned. We've been in the 1.4, 1.7 range for quite some time right now, and until I see further developments in the macroeconomic conditions, I do not plan to be overweight Tilt for now. So 8% is the current weighing, 15% is, I think, for now, the maximum weighing that we will hold in the Tilt for the foreseeable future, which would be potentially 3 to 6 months going forward. IWM is the fourth biggest holding, so the US small caps. I plan to keep it for now. Obviously, the economy has been hot lately, and I do think that the US small caps still have some upside. Obviously, we have to keep in mind the potential problems with the margins. I will talk about that later, but as of now, I think the US small cap space still has upside, especially given the fact that it has been quite heavily oversold in the last 2 months. Alibaba, 5%, 5.2% in the portfolio currently. I'm not planning any changes to this holding right now. We have been buying into this Chinese position over the recent months, but the general mood around Alibaba and other Chinese blue chips is still very bad. So I'm not definitely planning to add. I think in the longer run, we will want to see the issues with the regulatory crackdown being solved before making any bigger decisions on China. Although this market trades at very very good valuations. I think it's basically not time for bigger Chinese holdings because we're just not sure about the general systemic environment in China right now and how the party is planning to deal with that. So even though valuations are looking very appealing, I'm not planning any increase in the Chinese holdings for the moment. The reshuffles we have done in December in the portfolio were as follows. We closed three positions, two with a loss, one with a profit, which were Vestas, Solar Edge, and Booking.com. We also decreased the holding in Tilt and Gold, and we bought into PayPal. It had a very nice, quite deep correction of over 40% over the recent months, and generally the market consensus is still pretty bullish on PayPal, I think, given the fact that it's exposed both to the merchants and to the transactional market as a whole. I think PayPal is basically in a position to be increasing its long-term moat uh, against some other major players, which are also highly valued. So I think PayPal is a holding that we will want to keep long in the portfolio. We have built this position in December, and we're slightly up on the position right now. 2021, in short, internal benchmark was up 17%. Our portfolio ended up slightly less than 4%. We have underperformed, so there's space to improve this year, obviously. As far as the reasons are concerned, as obviously the Chinese exposure, we had some other Chinese names which we then cut, some with a marginal profit, some with a loss, but generally with what happened around the Chinese market, I'm not sure anymore that's systemically this is a good long-term exposure to be. We had this January, February rebalancing of the portfolio when we increased the exposure from less than 40% to over 70% because of our macro model readings, and we also kind of bought the short-term top, yeah, because around the break of January and February is where we had a top, and then we had a little bit of a correction in the growth space in general, and we had back then quite a bit of growth stocks in the portfolio, so this also made a difference. And then we also had some September, November volatility this year when we had worries about the Omicron, about inflationary pressures, and so on and so forth. So these were the major reasons for our underperformance. But in general, we had 7 winning months versus 5 losing months in 2021. So the ratio is quite good. It was pretty much September, January, and February where our portfolio basically lost versus its internal benchmark, and risk is generally under control. Average risk planned is 4. There may be swings between 3 to 5, obviously dependent on the general market volatility. But as far as risk is concerned and the long-term risk to reward ratio, we are in line versus our targets for the portfolio. Major market drivers in December, worrying start and a splendid at end of month, right? We starting December, we had quite a bit of wobbly markets around after the Omicron version started fearing the markets in general. But eventually December turned out to be ending quite well. The markets ended at around or at all-time highs, and the so-called Christmas rally eventually happened. 2022 assessments, so the general major question that the market participants are facing right now, inflation versus strong growth, is what drove December performance as well, where the major discussion was all about how we're gonna, or how the Fed is going to deal with inflation going forward, which obviously will have a major impact on the markets, on the equity markets, and on bond markets in 2022. Omicron, which originally looked very dangerous, turned out to be milder than feared, and its impact was kind of contained by the market in general. Christmas rally, that's what I said already, happened, although it came in kind of a bit late, but in December, the equity markets, the S&P in specific, was up over 5%. So we can say that the Christmas rally was there. Tapering, that's going to be faster than announced before. I'm going to talk about this in a little second. So the Fed is pulling brakes in general. Inflation is still the biggest issue, and it will remain so in 2022, not only in US, but in most of the equity markets around the world. Talking about tapering and the Fed, because I think it's basically one of the biggest determinants of the future performance of equities. Where we are now, right now, and where are we heading? In the post-meeting press conference on December 15th, Mr. Powell said that the FOMC plans to double the rate at which it will reduce monthly asset purchases. So as of now, the pace of tapering is going to be $20 billion each month in agency securities, and $10 billion $20 billion for US Treasury securities, and $10 billion for US agency securities, totaling a monthly taper of $30 billion. So at this pace, the Fed will stop adding to its balance sheet by March 2022. So be prepared that the general liquidity conditions in the system are going to be worse. And the question right now, obviously, is whether the economy and the markets are going to deal with it in a way that will not change the Fed's view of generally starting interest rates increases in 2022. As of now, you can see that the Fed balance sheet is slightly less than $8.8 trillion. It's still growing, but as you can see on the lower chart here, the dynamics, the year-on-year dynamics, are slowly starting to fall, and we should be expecting the year-on-year dynamics to be going lower into March 2022. Inflation, the second biggest issue. I just put on a little set of inflationary data for the US market here for you. 14 lines in general, and as you can see, the ones highlighted in yellow, it's 12 out of 14. All readings that we last saw were higher than the previous readings. So as you can see, inflation is generally very touchy issue right now, whether you're talking about the inflation rate itself, the consumer price index, or whether you're talking to GDP deflator, core inflation. All the readings are still increasing, so we need to be prepared that the Fed will be more and more keen to generally respond to that. in 2022. The worldwide macro heat map, there's three major issues I want you to pay attention to, and I think they will matter a lot in 2022. First of all, the one we have already mentioned, inflation. As you can see, inflation is hot pretty much all around the world. Here you see a list of 10 biggest economies. But it's not only the inflation. As you can see, over the course of 2020 and 2021, the fiscal debts or in most of the developed countries have been running extremely high, and that obviously led to a massive increase in the debt to GDP ratios. Um, for instance, United States are at 130% debt to GDP almost right now, versus less than 100% before the COVID situation started in February in 2022. So fiscal debts are going to be an increasing issue for the markets going forward, and we will definitely have to keep an eye on this. Some of you definitely do remember 2010 and 2011 when we had the European debt crisis starting out in Greece and then going over to other southern European countries, and we all know how it ended. So keep an eye on the debt in general, with the interest rates generally being planned to go higher. This is only going to be a bigger issue for most of the governments and central banks, right? So both of those groups, the governments and central banks, I think are very eager to monetize this debt. So in general, even though I think interest rates will be higher, the governments will be keen to keep real interest rates negative to basically monetize the debt, the increasing debt that they have issued over the last 2 years. The way to avoid those troubles, especially inflation, is obviously a usual choice of real tangible assets like real estate and equities. So I generally do think that there is not that many other options than real estate and equities to be in right now. We will see how it develops over the course of the year. Current valuations, you can see some data from Yardeni research here. As of now, the forward earnings for the S&P 500, that's the red line here, is at 222.65, so slightly less than $223 per share for the S&P 500 index. As you can see, the EPS, the 1 year forward EPS for the mid cap and the small cap space are naturally lower than that, but they also have a growing tendency over the course of 2021. Going forward, on this graph, you see the average revenues per share for the S&P 500. It's slightly less than 1,700 at this moment. The margin, and this is one of the worrying issues for 2022, the profit margins are generally flattening out, and if that basically persists and we see flat margin throughout the year for the S&P 500 stocks at around 13.5%, I think sooner or later we will have an issue with the valuations at current levels, because generally it will confirm the fact that inflation is generally eating into the profit margins of the US corporations. So be watching the profit margins going forward. I will definitely do that, and I want to keep a close eye on the profit margins for the US corporations in 2022. The current average PEs, forward PEs for the S&P 500, we're landing at around 21, 22. Mid caps and small caps are more fairly valued in general. and that's one of the reasons why I do plan to keep exposure to IWM ETF, because we want to be exposed to those smaller names that will generally be profiting still a strong growth in the US economy. The macroeconomic projections, that's the latest from the FOMC from December 2021. And as you can see here, the real GDP is obviously going to be slower than this year, but still, as of now, it seems that it's going to be a good real GDP growth of 4% for the US economy, then slowing down to 2.2 in 2023, 2024. The unemployment rate will look stable as of those projections, between 3.5% to 4%. But do pay attention to the PCE inflation. That's the Fed's most beloved indicator of inflation. As of now, the 2022 end of year inflation projection is 2.6%. In my personal humble view, I think it's kind of a wishful thinking. Remember that at the start of 2021, the Fed was projecting this year's inflation way lower than you can see right now, which is 5.3%. So I think in general, we have to keep in mind that the general Fed's projections is one thing, but the other thing is for them to still be accepting the fact that they want to keep monetizing the fiscal debt for the debt to be worth less in the future, because the debt burden has just risen so massively over the recent 2 years that the governments and the central banks are obviously doing everything for this burden not to cause another debt crisis. The Fed funds rate at the end of this year are planned to be at 90 basis points, and then expected to grow up to 1.6 in the year 2023. We'll see how it go. I would treat those projections with a pinch of salt. Basically, we'll see how it go. This year, the Fed has not really done great with their projections, so we will have to keep a close eye on how those macroeconomic indicators evolve throughout the year. Forecasts and expectations. Our macro model is showing that in January 2021, so pretty much right now, we are entering the boom phase of the economic cycle. That's the reading we have from the enhanced aggregate enhanced aggregate spread model from Dr. Robert Daly from nospinforecast.com. This would naturally induce lower equity allocations in our portfolio, which is cycle adjusted, but please remember that this cycle is much different than any other in a way that we have very high CPI, and the enhanced real spread is naturally positive right now, which is pretty much very unusual for this cycle phase. So we have an answer for this. We know why we are entering the boom phase as of the reading of the models, but for now we are not seeing other indications of a cycle peak just around the corner yet. For instance, because of the fact that the yield curve is not flattening as it should be. So for now, we plan to stay with the equity allocations of much higher than 40%, but obviously much caution is advised, and I think in 2022 we will have to be much more agile as far as general equity allocations. The Fed's quicker than expected tapering might induce risky assets volatility in the first quarter, so we'll definitely have to watch that too and see how it evolves. But for now, I think dips should generally be bought. So our internal benchmark is now officially going into a a weight of 50% US equities represented by the S&P 500, 25% gold, and 25% long-term treasuries. And this is the benchmark that we will be comparing our portfolio's performance this year. Unless we face the cycle peak, and then we will obviously change the weighings appropriately. Forecast versus risks for the 2022. My prediction is still pretty much the same as it was in my November post on eToro, given the current EPS projections and the current next 12-month PEs of between 21 to 24, we're coming at an end of year S&P target of slightly less than 4,900. I will just stick to that. This still gives some upside for the equities. I do generally think that if the market is able to withhold the tapering and the interest rates increases, we might even see some upside repricing of US equities. So if that happens, we might obviously finish higher as far as the S&P target is concerned, even with current EPS projections. The basic scenario assumes no recession in 2022. I do expect EU equities to do well. That's why we have added some of the European equity holdings recently, like the Norsk Hydro or Porsche or Logitech, for instance. ECB is behind the Fed as far as the monetary policy is concerned, so this will give the EU equities some edge, and that's why I think EU will do quite well this year on a relative basis. I would expect somewhat weaker dollar this year in general versus 2021. I do think that sooner or later we will see some kind of stimulus from the Chinese government, and the PMI should generally be increases, which generally gives upside to the Chinese equities. But please do keep in mind that we are basically facing a bigger question in China. And the question is really whether this market is still investable or not, given the regulatory crackdowns on the dually listed Chinese companies. I do have doubts about whether China is still really investable in the long term, and I will rather not plan to increase holdings in China this year. Risks, Fed behind the curve, right? That's the biggest risk. If Fed all of a sudden decides that they will have to suddenly catch up with the interest rates increases, this will most possibly cause massive downturn in equities and potentially even a recession. Hopefully we do not have to face that this year, but this is still a risk that is plausible going forward. Debt crisis, that basically corresponds to what I have mentioned earlier, the big fiscal debts and the debt to GDP ratios being extremely high all over the world recently. So a debt crisis is not something that is unthinkable in general. China, further regulations, that's also a risk. Stagflation, pandemic evolving into some other extreme dangerous variants. That's another risk. Some geopolitical risks, like for instance, what's happening on the Russian and Ukrainian border right now. It's definitely something that might cause the markets to destabilize this year. Crypto fallout, that's something that there's more and more discussion in the media about, from what I see and follow. So please be watching that as well, because I think that the big crypto fallout might, to some extent at least, destabilize equity markets as well this year. Inflation adjusted earnings, so the Schiller PE is also at extreme highs. As you can see here, it's touching 40, so pretty much levels where we were in the 1999 2000 internet bubble. So even though the EPSs are growing, given the fact that we have very high inflation right now, if you adjust for that, and even if you take a 10-year average as the Schiller PE does, the current PEs are not looking that great anymore. And this basically is a risk that we might be generally facing general repricing lower sometime in the future when the macroeconomic conditions become unfavorable, when the Fed becomes very aggressive in increasing interest rates, or uh, mm, in some other instances, like for instance the crypto fallout, which might happen pretty much any day. That's it for today. Thank you for listening to this video. If you consider copying me, please use $500 as a minimum amount. That's what I suggest to most of my copiers. Obviously, click copy open trades. Always copy and invest from the long run. So I think an absolute minimum for copying me is 1 year. In the long run, we're planning regular positive returns of on average between 9 to 13%, and a maximized risk to reward ratio represented by the Sharpe ratio and Sortino ratios, right? Always be patient and resilient through turbulences. That's basically what I always repeat. Thank you for everything. All the best to everyone in 2022. And that's it for today. Thank you very much and all the best.